These 15 charts will make you a better investor. Number 1, total real returns. Over time, here are the real inflation-adjusted returns from each asset class. Number 2, start early. We all know about compound interest, but this visualization will cement the concept in your brain forever. This is assuming real returns of 6.75% per year. If you're 25 years old, every $1 you spend today will cost your 65-year-old self $13. Spend wisely. Things cost more than you think. Number 3, bear and bull markets. You make more money by holding in bull markets than you lose by holding through bear markets. Lesson: don't try to time the market. Time in the market beats timing the market. Number 4, there will always be a reason to sell. This is the S&P 500 since 1950, overlaid with crisis events that induced selling. You don't have to look very hard to find a smart-sounding reason to sell. Number 5, you are your own worst enemy. This chart is not showing which asset class you should or shouldn't be in. The point is that the average investor earns far less than any asset class. Why? Their behavior. We constantly rotate between asset classes, chasing the hottest trend, instead of just sticking to a single investment mix for a long period of time. Number 6, the cycle of market emotions. Directly tied to the last chart, don't let your emotions control your investing decisions. They're likely steering you wrong. If you've ever seen Warren Buffett's quote, "Be fearful when others are greedy and greedy when others are fearful," this chart of market emotions is what he was referring to. Number 7, expect volatility. Here we have the largest intra-year drawdowns represented by the red dot and the annual return for that year in gray. The intra-year drawdowns can be huge, even in years we finish positive. You should expect volatility and be willing to hold through it. It's because of this volatility that we can make money as investors. Number 8, expect large drawdowns. Here are the largest drawdowns since 1928, with all the red figures representing drawdowns of 20% or more, which is the definition of a bear market. Not only should we expect volatility, we should expect drawdowns as the cost of earning long-term returns. Drawdowns are normal. They shouldn't be feared. Number 9, politics and investing. Stocks tend to do their thing regardless of who's in the White House. There will always be a narrative, but companies are innovative. Don't bet against the market based on which party is in office. Number 10, the Gartner hype cycle. This cycle refers to new technologies causing extreme emotional cycles for investors. Almost every new technology stock has a price chart that reflects this graph. Study it and prepare for it, especially if you're going to invest in new innovation. Number 11, driver of stock performance. In the short term, changes in valuation drives stock returns. In the long term, changes in sales and profits drive stock returns. If you're going to be a long-term investor, focus on the latter. Number 12, odds of success. If you want to increase your odds of earning a positive return, hold for a longer time period. Historically, every 20-year period has resulted in equities earning a positive total return. Number 13, 0% returns. Sometimes the stock market gives you 0% real returns. These are the longest periods of 0% returns. Number 14, ignore forecasts. Wall Street economists almost always predict higher rates than what we actually experience. Take this into consideration. Number 15, disruption. We are living through the most disruptive period in human history. Which one of these charts surprised you the most? Which one is the most enlightening? For me, it's number 5. Our behavior as investors is the biggest detriment to our own returns. Comment yours down below, and don't forget to subscribe. Big thanks to Brian Feraldi on Twitter for compiling these charts. You can follow him at Brian Feraldi.